Good morning, ladies and gentlemen. I want to do something slightly different today because we have the Fed, and there really isn't all that much point in analyzing every tick that is happening between now and then, and after the Fed, potentially everything will change. So I wanted to actually show you where we are in terms of risk, what has been happening for the past few months, and finally what one can expect and what the risks here are going forward. Are they high? Are they low? How to think about things. So we closed the week at 30 in terms of risk, and I will show you how and why. That basically what it's done is given us risk on in both the daily and the weekly model, and chances are that at the end of the month, which is what, 3 days away, we get a move to risk on the monthly model as well. This is pure maths, okay? So the moving averages are crossing because the price is staying above zero for a considerable length of time. Pure mathematics. There is no magic about this. What we have to do is analyze why the price is staying above and where it is in relation to where it was before. As you can see, the daily model is very volatile. The weekly model is much less so, and it tends to capture very long periods of rally in SPY, especially relative to TLT and bonds. So it tends to capture very long trends of risk on periods. This is significant, I think, at the moment, because I think we are going into a different type of risk-on period. We have been going nowhere, basically, for the past 2 years. And it's about time that we started breaking out. And I want to see whether the position of the current spreads is anywhere near indicating that we should be breaking out. Spoiler alert, it's not. But this is probably the kind of stuff that breakouts are made out of, because we are in such a neutral position. We will move away from neutral. The question is, do we move into a risk-on type situation or a risk-off type situation? And I would bet that the risk-on situation is A, more likely, and B, lower risk. The deviations have been absolutely excellent in catching the tops and bottoms. As you can see, we are very flat. This isn't the stuff that dreams are made of in terms of daily performance, but it could be the start of a long protracted period in which we rally something like 10% over the course of 3 to 6 months. Nothing as exciting as we've been used to, but then I will also show you that I think that we are going into a period of lower volatility per se, and that would make sense. So the S&P, it's been buffeted by all kinds of cross currents, some of them political and some of them due to the components of it. XLE has been going absolutely nowhere. You have, the defensive sectors that are tied to bond yields all converging in, showing that not much is going to happen here. XLU, I think, has completely shot its bolt, and I'm basically looking for this line to break the middle line, which will be the first time in about over 6 months, and that could provide our catalyst for change, and I will explore this further later on. The leader now it's beginning to be XLK. XLK is getting to levels, although it's overbought here, and it wouldn't be at least in the least surprising to let it come back before it goes again. XLK is beginning to lead again, as I will show you, and the other leader is XLF, which to me is very interesting. I think XLF now can become a true leader over XLK, and that is what is going to make the S&P higher at the end of the day. We will concentrate on this over the course of the rest of the video, and why I think risk on is more likely than more protracted trading sideways. As you know, everything is about the spreads, and everything, at least I believe so, and everything is basically either we're in periods of risk on or periods of risk off. This is one of the very, most elemental charts, and that is IEF, the 7 to 10 year area against the S&P. I use the IEF because it's clearer at certain times than TLT. TLT is much more volatile, and ILF tends to give you a better, a simpler picture. That's why I'm showing it to you here. So this is a very long-term chart going back to 2002. And basically in 2003 bottomed out. It gave us risk on all the way to 2007 and then collapsed into 2009. Was the first one to give us risk on back again. These moving averages basically smooth out all those price oscillations and give us a trend. So we can see where the trends developed. This was the big trend between 2013 and that ended sometime in 2015. Then again a great big trend when Trump got elected in late 2016, and that trend ended sometime in 2018. And since 2018 we've been basically going sideways. You can see that we really haven't had a period of intense risk off. What we have had is a period of oscillation between risk on and risk off. If we now enlarge this period, we can see that we really have no trend. The moving averages has been going up and down sideways, but still they are, the slope of them is not up or down. It's very neutral. This has been saying basically that since sort of mid 2000 or late 2018, or say October 2018, the situation has been unresolved. We might be at new highs in the S&P, but we're not in new highs or anywhere near new highs in terms of risk. Another chart I want to show you is the old world against the SPY. Simply because we are still in a period of outperformance by the US in terms of the moving averages. They're still pointing downwards, but it's very interesting that for the past couple of months the world has been outperforming the US. Now, I don't think that is so much a question of growth in the States being worse. I think it's probably a factor of too pessimistic an assumption about the rest of the world being slightly priced out. But I also think that it's beginning to be political. I think holding all your eggs in one basket in the States no longer makes sense in terms of risk, because the risk of some extreme Democrat coming to power are certainly higher than they were a few months ago, and therefore the market is trying to price it in. As you can see, if we enlarge this, we are not in a period of there is absolutely nothing here which is saying that this is a significant thing that has happened so far. Very simply, what has happened is that the market has gone back to the moving average, the long-term moving average. It's happened many times before, always rejected it. I think this time it's slightly different because of the political consideration and where we are in the political cycle. I would be very surprised if the ACWI over the SPY made a new low, i.e. if the S&Ps made a new high relative to the ACWI. To me, that says that there will be dips, and those dips are buys for outperformance and continued outperformance of the world relative to the US. Risk has leading components and also it has lagging components. Now this is a weekly chart of the semiconductors against the yen. Both very heavy risk factors. You can see how in 2008 this was actually the first, and don't forget this is a weekly chart, was the first to indicate that we weren't going to go down very much. And it's made a new high. That is not what you see when you are about to have a period of intense risk off. So that is what's tilting the scale to me, that we are in a slow period of transitioning to risk on again, proper risk on. The fact that the S&P is at 3,020 has nothing to do, the price has nothing to do with whether we are in risk on or risk off. It's the relative value of that price against another price that is important, i.e. should you be invested in primarily in the bond market, or should you in fixed income, or should you be primarily invested in equities, which makes more sense at the moment. And this is the first indicator that is telling me that a true transition, which we haven't seen for at least a couple of years, is beginning to take place. This is XLP over XLY, so something really boring like, toothpaste against the rest of the market. You can see how it has been going up relatively, shallow but up, i.e. people have been defensive overall ever since the middle of last year. It is impossible for the market to have a long-term rise in this kind of a position. There is no way, because of the component composition of the S&P index, that you can have a sustained period of bull market just because XLP is going up or XLU. They're just far too small to really influence the index that much. So my expectation is that XLP has actually shot its bolt. It certainly hasn't been going up for quite some time. In fact, it peaked in December 2019, and I would have thought that it's time for this one to start rolling over again. This is a very important chart. It's XLP over XLY, and as you can see, it's not really in a position as yet to give us intense risk on. What it has to do is it has to start trading below the moving average for quite some time to turn them, and B, it has to trade below a support line, this trend line that it's been in since the middle of 2018. Basically, all the spreads have been saying since the middle of 2018, I am not in risk on anymore. This is risk on. This isn't. The fact that, again, the S&P is at 3,000 has nothing to do with it. It's the relative value of other assets to the S&P. The S&P is at 3,000 because certain defensive sectors have held up so well and so much money has gone into them that basically it's kept it up there. That's all. So Now, what we are seeing here is that we must be very close to a break. This triangle is going to break one way or another. My favorite would be down, but at the moment the price is just not confirming it. Now this is XLK over SPY, so we're looking at the technology sector. Believe me, the QQQs are very much in the same kind of position, so I'm really summarizing things for you here. After a period of basically risk off, it gave the risk on signal, and this was it in hindsight, basically in June of this year. Since June of this year, XLK has held very well against SPY. Even though NQ has been going sideways, much like the SPY, and I've been saying, why buy the extra risk if the reward is the same? That is beginning to change. I think in the next couple of months we could see a breakout of the XLK over the SPY relationship once again. It seems to be in a very nice uptrend. We've had a long time, we've consolidated a long time. I'm not saying that that can't last any longer, but what I'm saying that it's unlikely now to start breaking down. We've had too much time, too many opportunities for the tech sector in the States to break down against the rest of the market. It hasn't happened. Chances now revert, the risk reverts to the upside. And this is, for those of you who've seen it before, very familiar chart of basically the spread between the 5-year and the 1 month. So basically the yield curve the banks are interested in, which has been going negative, 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 and the XLF. Don't look so much at the distance between the two, because it changes as you can see with the scale. What is important is the trend. So when the yield curve is going flat, it's not helpful for XLF, and when it turns, it's helpful for XLF. Now, the reason why I haven't really been looking at the traditional bond prices this week and so on is because I don't see the point. Not until we know what the Fed does and says. The market is anticipating one cut before the end of the year. If the Fed basically says, yes, that's it, that's what we're going to give you, and then we're going to be steady for a long time, I think people are going to move assets into risk on. Now, that is going to cause the yield curve in the States to steepen, simply because they will be selling their fixed income holdings to put them into equities. If that happens, the greatest beneficiary is going to be XLF. The yield curve will steepen simply because it's anchored at the short end. The Fed has anchored it. At worst, I mean, whatever happens, 2-year is not going to go above 180, 185. It's just not. Because the Fed, with easy money at 175, 180 overnight, plenty of liquidity, why wouldn't people buy the 2-year there? The euros, euro dollars are going to anchor the 2-year, but nothing is really going to anchor the 30-year. So to me, XLF, if you believe in the story that the yield curve will steepen and the Fed will indicate some kind of a pause, and we do get eventual risk on, as opposed to this rubbish that we've been seeing for the past 2 years, XLF is your best bet. So we've seen what some of the spreads are indicating. I've just shown you the main ones because there are thousands of them, and the score is actually weighted and in the risk dial, so we can see it any one day what the spreads are saying. The reason why they are remaining positive but not very much so is, as I've indicated before, is because a lot of the spread components, and I've just showed them to you, are not showing risk on, not true risk on. So volatility is the one that to me is showing risk on. The 200-day moving average is rolling over, all the averages are rolling over, the price is below it. If we now just have a look here, to me this is a bearish chart. To me this is a chart which is going to 12 or even lower. 12% volatility is not the stuff that bear markets are made of. Anybody who thinks the S&P is going to have a nightmare, it just isn't going to happen. This is the sign of a market which grinds, which does exactly what deviation says it's going to do. Suck everybody in at 3,050, spit them back out at 3,010 or 29.90, go back up to 3,060, suck them all in, etc., etc., until the true risk on kicks in, and we will see that in the score of the risk dial when it finally goes into the 80s and 90s. In conclusion, let's look at some facts and what might make sense in this scenario. Now, I've shown you the ACWI is beginning to outpace the SPY. It's glacial, okay? It's nothing enormous. It's still, the trend is still down, but I think that the intensity of the trend will definitely change. I think any dip in ACWI over the course of the next 2 or 3 months in relative to SPY is a buy, simply because it's an insurance policy and you can never have too much insurance. I think the risk of buying ACWI over SPY is very low over the course of the next 6 months or so, and therefore it's better to have something with lower risk and potentially a higher return. Now, the yield curve is beginning to steepen. That is a fact, okay? And I've been looking for a steeper yield curve for months and months and months. It's beginning to come true, and when it does, you have to press your advantage, and that is really best for XLF. I've shown you how XLF is in a position to now outperform, and I've shown you how the tech sector is beginning to lead again. You're getting the first new highs in a long time from the stocks against the yen. You're getting a very stable situation in K over SPY, and therefore that is, you cannot say that that is bearish. You can say that that is at the moment neutral because it's not really in a strong trend, but you can't consider it bearish. Fixed income against the equities is showing absolutely nothing conclusive at this stage, and many of the other risk factors that I've shown you are not conclusive in any way. That to me says whatever trend there is, if there is one, is not strong. On the other hand, finally, we have another fact: volatility is falling. To me, that is the best argument that when the trend does change, it'll change into strong risk on. So my conclusions from all this is that A, the defensive sectors are going to be depressed, if I'm right, by the steeper yield curve, and that will make the rally in S&P shallow. It makes sense, right? The S&P to me will, the multiples will not expand because higher bond yields are not conducive to multiple expansions, and therefore the S&P is going to be very much anchored around these levels with low volatility. I mean, low volatility says low volatility on the upside as well as the downside. Therefore, ranges to stay small. If that happens, the danger of missing a big rally but not being aggressively long of equities here is also small. but the risk of not buying dips of 1 or 2% of magnitude is a small risk. Preferring equities to bond here is, to me, perfectly logical. It's still marginal, but logical. But I think the risk reward is going to get better over time. Therefore, to me, these portfolio actions make perfect sense. The diversification away from the US makes sense from a pure insurance point of view. Now, I am prepared to lose some money on that view simply because the consequences of some nutter Democrat getting into the White House are so incredibly bearish. I think the multiples would go from 17 to 15 in the blink of an eye, and that is a 15% move in the S&P, overnight. The odds of overweighing the XLF and XLK are better than not doing it. The risk reward is better. Upping the equity allocation to around the 70-75 mark makes perfect sense, and one should still ride the short volatility curve. 200 basis points and more of futures over the spot is just not justified in my eyes, and every time the futures rally, there is sell. Thank you very much indeed. Tweet you on Monday. Let's see what the Fed does, and should prove to be quite interesting, certainly for the yield curve.